Thanks to the organizers for inviting me to present this paper. This is joint work with Roberto Cram, Hanno Lustig, and David Zeke. And this paper is part of a broader research agenda that we've been working on, thinking about monetary-fiscal interactions and their impact on government funding costs. And like what Jessica was presenting earlier, we're going to be taking an asset pricing view. We're going to be looking at how these monetary fiscal interactions are going to affect bond risk premia. But the angle we're focusing on is going to be, instead of kind of aggregate shocks, we're thinking about redistribution risk of fiscal policy as being a driver of bond yields and term premia. And so at the core of this paper, we're going to be thinking about this trade-off that governments and central banks face when deciding how to pay for major fiscal expansions. Do they want to protect taxpayers or bondholders? And if we look over history, we're going to see that policymakers have often chosen to protect taxpayers at the expense of bondholders with unbacked fiscal expansions and monetary accommodation. So what we're referring to here with unbacked fiscal expansions, large increases in government spending, like we saw during World War I, World War II, also COVID, with these stimulus packages that are not backed by explicit promises of future taxation to pay for these surges in spending in present value terms. And if you look at bond markets in the aftermath of these surges in fiscal expenditures, you're going to see that the cumulative real losses on nominal government bonds, or the aggregate Treasury portfolio in this case, range from 25 to 50%. And on top of these surges in unfunded spending in these three events, in these past couple of decades, we also see a persistent rise in unfunded obligations arising from Social Security, Medicare, Medicaid. And in some related work, we also look at, we extract high-frequency shocks about these unfunded deficits over these past couple of decades by looking at individual legislation. We also find similar patterns in that there's a systematic decline in the Treasury values on these news about deficits. So from the government's perspective, this nominal devaluation of debt helped pay for these fiscal expansions. And what we're going to show in this paper is theoretically illustrate how the fiscal redistribution risk between bondholders and taxpayers increases government funding costs through bondholders demanding higher risk premia. Okay. And so we're going to begin our theoretical approach by building a tractable two-agent endowment economy model that features fiscal and monetary interactions. So we're going to have two types of agents: intertemporal asset holders that can save in government bonds. So we'll label these as bondholders. And then we also have a fraction of hand-to-mouth agents that only can consume their disposable income, which we can label as the taxpayers. And then the policy stance can be captured by simple monetary and fiscal rules that I'll outline shortly. And then in our simple model, we're just going to have only one shock to government spending. That's going to be fully distributed as transfer checks to agents. And then finally, there's going to be a government budget constraint where these government expenditures are going to be funded by nominal debt and taxation over one period. But of course, intertemporally, the policy stance is going to pin down how much tax versus inflationary finance we're going to use to pay for these fiscal expansions. And then we're going to use an asset pricing approach to solve this model to capture endogenous risk premia. And we're going to analyze two policy regimes: a fiscally led one that exposes bondholders to unfunded fiscal risk. And then we're also going to look at a monetary-led one that's going to insulate bondholders from fiscal risk. Okay. So just a preview of the main results. We're going to show our key result is to show that the combination of a fiscally led policy regime and limited asset market participation will provide a fiscal redistribution mechanism that generates a fiscal bond risk premium. And so we need these two ingredients. The first one, this fiscally led policy regime, will make the ex post real government bond returns state contingent, so it'll make debt risky. And for this fiscal risk to be priced, we need to break Ricardian equivalence And then we have this limited asset market participation, this fraction of hand-to-mouth agents. Effectively, what's going to happen is that this unfunded fiscal expansions are going to redistribute asset holders' wealth to the hand-to-mouth. That's going to increase the marginal utility of the asset holders or the marginal investors in bonds and increase the pricing kernel, and that will give rise to a bond risk premium. And then in this simple model, we're also going to abstract from any deadweight costs or other frictions besides limited asset market participation. So we're focusing on pure fiscal redistribution. And then we're going to show that other permutations of the model, fiscally led rep agent, monetary led, limited asset market participation, monetary led rep agent are going to generate zero bond risk premium with respect to fiscal shocks. And then also to contrast our framework from other rep agent models of the term structure, we're going to rely on pure fiscal redistribution risk rather than stagflation risk. And then at the very end, we're going to embed this framework into a small-scale new Keynesian model to quantify this mechanism. We're going to calibrate this. We're going to discipline to the extent inflationary finance is used by matching the dynamics of the unfunded share. And we're going to show that unfunded fiscal risk can explain around 50% of the bond risk premium and nominal term premium. Okay, so now let me jump in to our theoretical framework. I'll start off by describing the agents. There's two types of agents. So there's going to be a fixed fraction of asset holders that have Epstein's N preferences. Okay, so these preferences are going to be important, especially as I'll show you shortly. The important redistribution effects are not just the contemporaneous ones, but the redistribution of wealth. And that wealth impact is going to be priced with these Epstein's N preferences. And then we're going to have the remaining fraction, hand-to-mouth, that consume their disposable income. And then each household receives a constant real endowment in each period. And then monetary and fiscal policy are going to be summarized by these first two bullet points. So the central bank is going to follow a simple nominal interest rate rule that depends on inflation deviations from target. Government's going to follow a tax rule that depends on debt deviations from target. And then taxes are levied uniformly and also in lump sum across agents. We're just going to have one shock in this model, XT. And this government spending is also going to be distributed uniformly as stimulus checks across all agents. Okay, so we don't have any deadweight loss here from government spending. And then finally, there's the one period government budget constraint. The government's going to issue one period nominal debt and raise taxes to pay for government expenditures today. And one useful identity we're going to use, particularly with our asset pricing approach for solving this model, is that the intertemporal government budget equation, so if we iterate this identity forward, we get a present value relation that links the market value of debt to the present value of surpluses. If we combine that intertemporal government budget equation with this one period budget constraint, we can also re-express this as a bondholder's return identity, which tells us that, which is at the very bottom, that this hypothetical return to a claim on real surpluses is going to be equal to the return on the government bond portfolio, here just this one period debt, minus inflation. Okay, so the ex post real return to the Treasury portfolio is going to be equal to this return on surplus. And then the optimal consumption savings decision of the asset holder is going to give us this Euler equation here with respect to this government bond returned. And one case we're going to look at that gives us cleaner analytical solutions is we're going to look at a limit case. We'll relax this later, but for the solutions I'll show you, we're going to look at this limit case where we have infinite IES, which effectively gives us this CAP-M type pricing kernel. So if we had finite IES in this log stochastic discount factor, we'll also have a realized consumption growth term, which drops out with infinite IES. So this is going to give us cleaner solutions, and furthermore, our key mechanisms actually operating through that second term, this return on wealth, okay, that I'm going to characterize shortly. So just to summarize this model, it's a very tractable model, 5 equations. And just a few things I'm going to comment on. To solve the model, we're going to take a Campbell-Schiller approximation of this return on wealth for the asset holder, that's RA, and also also a Campbell-Schiller approximation to this return on surplus, RS. And one other thing to point out is these star variables are risk-adjusted steady states. And so with these models where we're accounting for risk premia, we also need this iterative procedure to obtain these risky steady states to center these policy rules. Okay. And to formalize these policy regimes that I was alluding to earlier, we can parameterize or partition these policy coefficients. So rho pi, the inflation coefficient from the Taylor rule, and delta B, the coefficient on debt in the tax rule. We can split this into 4 regions, like in the Leaper 91. And there's going to be 2 regions that are going to give us unique and bounded solutions. So one is going to be this fiscally led policy regime, where we have passive monetary policy, so Taylor rule is not satisfied. And we have non-Ricardian fiscal policy, this delta B less than S star. So any increase in spending today is not going to be fully funded in present value terms by future taxation. So in this regime, we're going to have to rely on some degree of inflationary finance. How much inflationary versus tax finance we're going to use is going to depend on this delta B parameter. The other regime is monetary-led. This is our textbook monetary framework. Taylor principle is satisfied. Fiscal policy is Ricardian. Okay. And then what we're going to show is that the fiscally led regime and this limited asset market participation is going to generate a fiscal bond risk premium that increases government funding costs through a redistribution mechanism. And then I'll also highlight that these other combinations of this model are going to give a 0 fiscal bond risk premium. So let me start with the fiscally led regime. Okay. So this is our fiscal theory framework. And this framework is going to feature the risk of unfunded government spending, which is given by that parameter restriction delta B less than S star. Okay, and so just a heuristic interpretation of the mechanics in this regime is if we have a fiscal expansion, we increase spending, it's not going to be backed by promises of future taxation to offset that or pay for that in present value terms. That's going to reduce the fiscal backing for government bonds, which is that right-hand side, the present value of surpluses. And so in this regime, we're going to have, this will require for fiscal solvency, inflationary finance, and that's going to devalue real government bond returns. Okay, so the real return to nominal government bonds, this is going to be state contingent. It's going to be risky. But of course, for this fiscal risk to be priced, I'll show you later, this will also hinge on whether or not we have this other friction, this limited asset market participation. And then the central bank in this regime is going to accommodate fiscal expansions by preventing government funding costs from exploding or rising too quickly through passive monetary policy. Okay. And then in terms of the solution here, we're going to solve for the log real value of debt forward using this Euler equation for the return on surplus. And we're going to solve for log inflation backward using the intertemporal government budget equation expressed as this bondholder's return identity. And we're going to obtain the consumption policies using the hand-to-mouth budget constraint and goods market clearing conditions. And then finally, we solve for the asset holder's wealth using this Euler equation for the return on wealth of the asset holder. And here I'm showing the inflation policy function in this regime. And what we can see is that this coefficient on the spending innovation, something we can sign, that's positive. Okay, that's just illustrating that inflationary finance pays for the unfunded portion of the surprise fiscal expansions. And how large that coefficient is, those A1 depends on these policy parameters. So for example, how large delta B is will dictate how much inflationary finance we use, and will affect that magnitude or that elasticity of inflation with respect to these spending shocks. And then we can also see that the ex post real government bond returns are state contingent, also depends on the shock, and has a negative coefficient with respect to the spending shock, epsilon. And so surprise unbacked fiscal expansions lead to real losses on government bonds. And note that the bond return dynamics do not directly depend on the fraction of asset holders, right? So this is just this intertemporal government budget equation. We have unfunded spending. Those costs are going to be passed through to bondholders. But then in terms of the pricing of fiscal risk. This is where this redistribution, in this case, matters. So I'm going to describe the redistribution dynamics. I'm going to split it into two components. Look at the contemporaneous redistribution. Also to emphasize that if we look at the monetary and fiscally led regimes, you're going to see that the contemporaneous redistribution is going to be identical in the two regimes. And what the policy stance affects is then the expected future redistribution. So here we have the contemporaneous distribution in this fiscally led regime. So when there's a fiscal expansion here, asset holders' consumption goes down. So what's happening here is there's a bond loss. The real value of debt is devalued. And that's going to exceed the transfers that these agents get, and they're going to decrease consumption. In contrast to hand-to-mouth agents, they do not exposed to any of the costs of the fiscal expansion. They're going to receive higher transfers that are going to increase their consumption on impact. And if we look at the expected future redistribution, here I'm characterizing it by pricing claims to consumption of hand-to-mouth and also asset holders. And you can see that the asset holders' present discounted value of future consumption also goes down, reinforcing the initial redistribution effects, while the hand-to-mouth present discounted value of future consumption goes up. Effectively, what's happening here is the asset holders are effectively subsidizing the transfers to hand-to-mouth agents. Okay, so we have this wealth redistribution away from asset holders to fund a higher consumption path for the hand-to-mouth agents through bond markets. And the fall in wealth, in real wealth of these asset holders, that increases the marginal utility of these asset holders. In equilibrium, their intertemporal marginal rate of substitution is equal to the real pricing kernel. So we can see that the real pricing kernel goes up in response to these fiscal expansions through redistribution. And that's going to give rise to fiscal bond risk premium, right? A fiscal expansion reduces the real returns to nominal government bonds. It also increases the stochastic discount factor. This is going to give us a fiscal bond risk premium. And then note that in the rep agent case of this fiscally led regime, if you substitute that in, you're going to get that the pricing kernel is going to be insulated from these fiscal disturbances. We're back to Ricardian equivalence. In this case, their bond wealth is still devalued, but they're going to receive the entirety of the transfers. That's going to offset their bond loss. And so consequently, their real wealth stays the same, okay, and the pricing kernel doesn't move. Okay, so debt is still risky in the fiscally led regime, but for it to be priced, we have this limited asset market participation that breaks Ricardian equivalence. Okay, and then if we substitute in our inflation policy function, also a real pricing kernel solution, this model also implies a one-factor model, essentially a discrete time Vasicek model. And so there, this $M, that's the log nominal stochastic discount factor. The state dynamics are given by this inflation policy function that I showed a few slides ago. And then also this market price, or the price of risk of fiscal shocks, is here, of course, going to be endogenous, depends on policy parameters and other deep parameters of the model, along with the risky steady states. And then we can also show that this model will generate a nominal term premium strictly through redistribution risk. Okay. And now let me contrast the fiscally led regime with the monetary led regime. The monetary led regime is where the central bank targets and stabilizes inflation with this Taylor principle being satisfied independently of fiscal concerns. And the government's going to accommodate the central bank by fully backing fiscal expansions through this Ricardian tax policy. So any increase in spending today, there's going to be an explicit promise that's going to be paid for in present value terms by future taxation. Okay, so in contrast to the fiscal regime, government bond returns and the pricing kernel are going to be insulated from fiscal risk in this regime, whether or not we have limited asset market participation or rep agent. And so in this regime, how we solve it, we're going to be solving forward, inflation forward, using this nominal bond pricing Euler equation. And because we only have fiscal shocks in this model, inflation is going to be constant. Therefore, the bond return is also going to be constant. And then we also are going to have safe debt. The nominal bond return, also ex post real bond return, all going to be constant in this regime with respect to fiscal shocks. And then we're going to use the government budget equation to solve debt backwards. And then same thing, we're going to obtain the consumption policies of each agent through market clearing conditions and budget constraints. And just to illustrate the differences in the mechanics in terms of the redistribution across these two regimes, the initial redistribution effects in response to a surprise fiscal expansion, those innovations are the same, although the underlying mechanics are a little bit different. So here, asset holders' consumption also goes down on impact, even in this monetary-led regime. They're going to absorb the entire new debt issuance to fund the higher expenditures over this next period. That's going to crowd out some of the consumption, leading to this initial drop in consumption. And in contrast, the hand-to-mouth agents, they enjoy higher transfers without facing this initial, without needing to absorb this initial debt. But if we look at the intertemporal redistribution, or the expected future redistribution across these two agents, now we have a reversal. Okay, so in the fiscally led regime, the future effects, the future redistribution effects reinforce the initial consumption response. Here we're going to have a full reversal, okay, because of this Ricardian tax policy. So what's going on here is, again, with this surprise fiscal expansion, the asset holders, they're going to receive the entirety of the higher future surpluses from owning bonds because of Ricardian tax policy. Okay, but they only have to pay part of that future tax bill because that's going to be shared with the hand-to-mouth agents. Okay, so, and then the hand-to-mouth agents, their future consumption goes down. They're now going to face a higher future tax bill without receiving any of the benefits of future bond appreciation that the asset holders will be able to benefit from. And in this case, these future responses, they're going to exactly offset the contemporaneous responses. And so asset holders' wealth, and therefore the stochastic discount factor, are protected against fiscal shocks. Okay? And in the last couple minutes, I'll just describe the quantitative evaluation of the model. So we're going to extend that framework I just showed you to a small-scale new Keynesian model. We're going to add in endogenous production, labor supply, sticky prices, long-term nominal debt, and also some additional structural shocks, monetary policy, supply, and also demand shocks. And we're going to look at different policy specification, but the benchmark we're going to look at is just a fiscally led regime with partially backed government spending. Okay? And to have partially backed government spending, so we're going to have a combination of both tax and inflationary finance. This is going to require a tax rule with this debt coefficient to be negative. And how we're going to discipline the extent to which inflationary finance is used, right? That's not something we can observe. We're going to try to discipline that by looking at data from our other paper, our empirical paper, where we actually look at the legislation level, where we classify bills and their kind of cost based on whether they fall under the budget rules, in other words, funded, and those that go off the budget rules, which Congress has increasingly used in these last couple of decades, and is, of course, a contributor to the deficits. And so that share, that unfunded share, is how we're going to discipline the extent to which inflationary finance is used. And so here are some of the moments from the data. So there, the first row, that's the 5-year minus 1/4 yield spread. And then the other kind of key second moment I'm reporting is the fraction of total government spending volatility that's accounted for by unfunded spending. Just one caveat there is that data we only have starting from 1997. Okay. And so that's something we calibrate. So our baseline model is able to generate a sizable nominal yield spread with moderate risk aversion, okay, while still being consistent with macro and surplus fluctuations. And if we decompose the contribution of the shocks for this nominal yield spread, we're going to see that the fiscal shocks, so that base lamp case, that's our benchmark model, the more than, I think, around 57% of it is generated by this fiscal redistribution risk that I highlighted earlier. And then we also have some other specifications. We also have an extension that incorporates stochastic volatility that also gives some risk amplification. And then this last column, we have this hybrid specification. That's another way we can get at this funded versus unfunded share. That's related to a policy specification of Bianchi, Faccini, and Malosi, where we have both monetary and fiscally led regimes coexisting. But the bottom line is, as long as we have some unfunded fiscal risk, Okay, and that inflationary finance is used. Our paper is highlighting that this is important for government funding costs through a risk premium channel. Okay, and in our model, we highlight two key dimensions: this fiscally led policy regime, okay, and that makes bond returns risky or state contingent. And then the second component is combining the fiscally led regime with limited asset market participation, and that will also increase the real pricing kernel in response to these fiscal expansions, so that fiscal risk is priced and generates a bond risk premium. And then that final exercise is just quantification, and when we calibrate to the dynamics of the unfunded share, we find that unbacked fiscal risk is a significant cost to government financing. Thank you.
Thank you very much. So, Jim, floor is yours.
Hi, can you hear me? I don't know if I have to talk into this mic or just talk, or, all right. Thank you. Well, thanks very much for the invitation to discuss this beautiful paper. It's a very important question whether or not whether inflation risk is reflected in risk premia on government bonds. To be honest, 5 years or so ago, this would not have crossed my mind at all, because my instinct was that in advanced economies, we had fallen into this post-history paradise in which inflation targeting was credible, and therefore there really wasn't much role anymore for thinking about inflation risk premia on bonds, okay? But this paper goes ahead and tries to take a look at that. And of course, we had a very nice paper earlier by Jessica on extremely similar issues. The difference is I'm mostly a macro person, and so when I look at one equation from finance, that's interesting, but I always try to figure out how it fits into the macroeconomy. This paper very elegantly takes the asset pricing block and fits it into a fully general equilibrium picture of the economy, and does it in a way that's easy to understand, okay? So I'm going to try to take us all through the relatively simple equilibrium structure here. So at any rate, the main conclusions here, before I go on, is that we're gonna see that this model can generate a regime of monetary dominance in which debt is safe, and so then there's no longer any inflation premium on bonds, but it can also generate a fiscally dominant regime in which we're going to expect inflation to rise whenever a spending shock hits, and therefore that's going to generate an inflation premium, okay? It's a little surprising to me to see that they're taking this model to the data not just right now, when this starts to be very believable, but also over the previous decades. But they make a pretty good argument for that. Okay, so quantitatively, when they take to the data, they show this looks like it could be a quantitatively important mechanism. All right, so very beautiful model. Let's look at it a little bit of how it works. So this is the model, all right? It's Lucas asset pricing plus heterogeneity turns out to be crucial here. You need different savings behavior for different types of agents. And then we're going to go into the standard Leaper monetary fiscal types of equilibria, okay? So there's a tree. The tree pays off some constant fruit. Now, on top of that, the government can also redistribute some of that fruit between people. And so there's this persistent shock to government transfers to the population, okay? All right, so there are going to be two types of households. On the one hand, there are savers who are holding all of the assets in this economy in equilibrium, and so we're going to use their stochastic discount factor to price all the assets. And then on the other hand, there are also some hand-to-mouth households who are simply going to be consuming whatever is given to them at any point in time. Okay, so zeta is the fraction of savers in the economy. And then there's a policy block. There's a Taylor type rule, which may or may not follow the Taylor principle, namely that rho has to be greater than 1. And there's a fiscal rule, which I didn't write down, but it's just saying that taxes respond to the debt level. Okay. So now to close this, you need a couple of other. You need to impose market clearing. Okay. And this is an exogenous supply model. So people who are simply consuming their income every period are going to eat the fruit from the tree plus the transfer, which is to say minus the surplus of the government. All right? And that means that the asset holders, the ones who are not hand-to-mouth, they're going to have to finance all of that. So the more hand-to-mouth agents there are, that's 1 minus zeta, the asset holders are going to be having to greatly increase their, they're going to be increasing their consumption only if the government is running a surplus. And when the government is instead making transfers, they're going to have to pay for all of that. Okay? And then we're going to look at two different policy regimes where we have different configurations on the rules. Okay? All right. How do we solve all of this? Well, fundamentally, you can break it all down into different pieces. So under monetary dominance, you can just solve the Taylor rule forward. There's only one non-explosive equilibrium, and that's the one where inflation does in fact stay at target. Okay? Once you know that, you know there's no risk premium on the bonds. So once you know that, you can just take the fiscal rule, solve it forward, and find out what the path of debt is. Once you know that, then you can just use budget constraints and market clearing to figure out what the two types of agents are going to be consuming. So that means you can calculate the pricing kernel, so then you can price everything in the economy. Okay? So this is nesting a macroeconomy with heterogeneous agents and asset pricing in this very beautiful, simple, elegant way. Okay? And so in that regime, inflation is stable and debt is riskless. Now, it's a little more complicated to solve the fiscally dominant regime, but the basic idea is that we're going to take a linear approximation to all of the different asset pricing relationships, and then we're just going to do a method of undetermined coefficients to solve for the unknown functions in equilibrium. Okay? So fundamentally, there are two things that are going to have to be satisfied here. On the one hand, you can think of bonds as being claims on the government surplus. Okay? So you can ask, what is the return on the claim to the government surplus? And that's going to have to be compatible with the Saver's Euler equation for bonds. Okay? So M here is the stochastic discount factor, and then RS is the return on holding bonds. Okay? Now, on the other hand, you can also think about savers' wealth as being a claim on their consumption, because I mean, after all, they're using their consumption they're using their wealth to finance all of their consumption, and they're hitting their budget constraint. So you can think of that exactly the same way as we thought about the surplus. Okay? So likewise, you can think about the returns on savers' wealth And so you get an Euler equation as well that has to hold for the for savers consumption. Okay. I should have mentioned that all of this is being done under complete markets because that's essential for the asset pricing relationships that we're figuring out. Okay. So the RS and the RC you can basically construct from the dynamics of taxes and bonds or of consumption and wealth. The marginal, the stochastic discount factor, what you need to do is figure out what is the shock to their consumption. But that can be endogenized simultaneously with the with solving the Euler equation. Okay? So basically, the stochastic discount factor is that. The returns on bonds you can just calculate from the tax rule and the dynamics of the fiscal shock. The returns on, sorry, that last line is supposed to say the return on wealth, RC, is calculated from the dynamics of the fiscal shock and the budget constraints and market clearing. Okay? So those are a bunch of equations which you can plug in and back out all of the coefficients. So, so the key findings are, once you solve for the linearized debt rule, you see that an increase in government spending, X, is going to have a negative impact on real debt. Okay? Why is that negative? Well, because in the fiscal dominance regime, delta B is less than S, and rho is less than 1. So that's a clearly negative coefficient. Okay? Likewise, the linear representation of savers' wealth also has a negative coefficient on spending. Okay? So that is to say, when spending rises, savers' wealth has to decline. Okay? And then finally, you can also back out the dynamics of inflation. And there you can see, I am missing the inflation shock at the end of that equation. The coefficient kappa 2 minus kappa 1 A1 is positive, meaning that when a shock to inflation occurs, when a shock to spending occurs, inflation is going to rise. Okay? Okay. So now all of that, what I was just explaining, was the fiscally dominant regime in the heterogeneous agent economy. How do these things fit together? Well, actually, it's not just the policy regime that matters here. Heterogeneity is absolutely crucial for this argument. Okay? So they compare four different configurations. One would be monetary dominance with a representative agent. Another would be monetary dominance with a heterogeneous savers. In all of those cases, the Taylor rule nails down inflation, stabilizes it, and so all the risk premia disappear. Okay? Now, the interesting case to think about is fiscal dominance with a representative agent. Well, in that case, when spending rises, it's going to have to be deflated away. But the representative agent is both receiving a transfer and losing some wealth in a way that exactly compensate each other. So, so consumption is fully insured against these fiscal shocks. So there's no correlation between the inflationary losses on debt and consumption. Okay, so that risk is not priced. So again, you get no risk premium. Right? The risk is going to be priced if the savers have to absorb those extra transfers that went to the hand-to-mouth folks. Okay? So they are, when transfers occur, the savers are losing more than they're gaining from the transfers to the government. Okay? And so in particular, the real bond returns are low precisely when the savers' consumption is low. So that's a risk that gets priced, and that's what generates the inflation risk premium. Okay? So as they, I guess we're both skipping rather quickly over the quantitative extension. The quantitative extension is great, and I would like to see the paper go more in that direction, but it's just reinforcing what we already knew from the beautiful theoretical example. Okay? So I have no criticisms of the underlying model. It's a beautiful illustration of an important point. As far as the quantitative model, it would be really nice to see more done with that. And I don't know if that's going to be a second paper or if it's this one. But at the moment, the paper is taking average conditions over the last 60 years and comparing them, calibrating the excess bond premium to that period. And then they show that you can get both the level and the standard deviation simultaneously of inflation and of bond premia, okay? But weren't there some changes in the last 60 years, okay? Treating risk as something that's just fixed over the last 60 years stretches my credulity. And of course, the other thing is, why not look at inflation compensated bonds as well? Okay? So if you just take this to the data and look at nominal bonds versus TIPS, since the two are both available, what I see there is a constant difference of 2%. Okay, so it's true that the two enormous recessions in this period did both shrink the premium on nominal bonds. But other than that, what I see is like 2% compensation for 2% inflation target over that whole period. So I don't see the time varying risk that this model would indicate. Okay, so I think it's a beautiful paper. It has a huge amount of empirical potential, but there's going to be some tough stuff to explain if you actually do try taking this to the data. Okay, so thanks very much.
Thanks a lot, Jim. Okay, let me open the floor for questions, and then I will give an opportunity to Howard also to react to Jim's comments. Giovanni, please.
It was fast. So, Howard, great paper. I really loved it. Very, very interesting. The only issue that I have is on the motivation, because when the problem that I get is when you link into the pandemic, because that is not a pure fiscal shock. It's a fiscal shock in response to another shock. And for me, this changes completely the insurance situation and picture behind it, because with a demand shock like the pandemic, of course, your mechanic works very well. But if you put a shock like it was for Europe, the energy shock, then, and I might get it wrong, but the result is completely the opposite, because then you have an inflation increasing shock that in a monetary dominance comes with a interest rate increases, which is a double whammy of course, for existing bondholders. That is also an important difference, no? Respect for future ones, but existing bondholders at the time the shock hits. Whereas a fiscal dominance might see interest rate being constant, so they are hit only by the inflation fact. So it works perfectly fine, your model, for pure fiscal shocks. The only question / concern that I have is when we put them in reaction to shocks. Thank you.
Thanks, Giovanni. Any other questions? Yes, please. We have a question in the back.
I think
Please take the microphone.
Yeah, one of the things you could do with this model is ask the question, like, is this bad? Like, do we have risk premia, but, they get paid more money, so maybe it's okay. So the question is it bad to have this redistribution risk or this fiscal default potentially, and who is it bad for? I would assume it's bad. Is it worse for your hand-to-mouth folks to actually bear to what they would, to kind of get the benefit of the default, but then maybe they get less overall because of the risk premium, or maybe it's not bad. But I assume sort of the premise of the discussion is that default is bad.
Thank you. Yes, Leo, please.
Following up on this, maybe one quick point. I see, the channels that you have: fiscal dominance, monetary dominance, heterogeneity, yes or no. But going forward, I wonder, assume someone would try to go actively more often for this fiscal dominance regime with heterogeneity. This requires inflation, surprise inflation, for the mechanism that you want to use to, to fund initially unfunded spending. But this means that you lose the price stability anchor in the system, what you called pi star, right? Because you would have to, I think you would have a drift towards higher inflation. And then if the idea is to embed it into a macro framework with traditional feedback rules, I simply wonder what is the anchor for inflation? I think there would be none left.
Thanks, Leo. If there are no further questions, let me just add one myself. Have you thought about the external economy dimension? Because you have a closed economy set up, so basically the domestic savers bear the entire cost. But if you think about the US Treasury market, actually you have very large foreign holdings, and how would that affect your results? Yeah. So please, Howard.
Okay. Yeah, well, thanks for all the questions and also the discussion. With regards to the last point with like the term premium perspective, I think our other companion paper actually tries to get at maybe the heart of this mechanism, which what's key is actually identifying unfunded deficit shocks. And so this is something we do looking at cost revisions from the CBO at the individual budget level, and also in the US budget, we can also figure out which proposals are off budget, like emergency spending, for example, like the Ukraine war, also some of the transfer checks or stimulus stuff during COVID. And so we can do a high frequency identification with these type of shocks. And so what we find systematically over where the sample starts and 97 to now, we find that I think I mentioned earlier, you get that the Treasury value declines, but when we try to decompose the channels, what we find is that the main drivers of that change is coming from nominal term premia increasing when there's this unfunded deficit news, and also expected inflation going up. So those two things are kind of in line with the model. Then to the question with the pandemic shock. So right now in our kind of example that we had, it was these shocks. Well, there was only one shock in the simple model, and then even the quantitative model, just to kind of make the exercise clean, all the shocks were orthogonal. So it wasn't dependent on the state of the economy, whether there's this fiscal expansion or not. And indeed, during the pandemic, there was high inflation, and we'd like to think a large component of that was fiscal inflation. Of course, there's also demand and also supply inflation. And so that's why the way we've disciplined that in the model is to look at the unfunded share. Okay, so from our model, that unfunded share has to be paid for in this framework where there's not default. But quantitatively, in some sense, if you look at when there's really big unfunded expenditures, because the other thing that our model misses out is all the shocks are Gaussian. But if you look at the actual government spending process, in particular the unfunded share, that really spikes up in bad times. So of course there's the wars, but more recently the GFC, post-GFC, post-2020. And so that would also give an extra kick to our model, if that we also have this unfunded fiscal expansions in bad states of the world. That's only going to further increase marginal utility of the asset holders. So that would actually give some extra kick there. And then from the welfare standpoint, so in terms of when there's unfunded spending in this fiscal dominant regime, you could see if you look at the utility to consumption ratios, then the asset holders, they're going to go down in terms of the realized path, and then they're going to go up for the hand to mouth. But in the steady state, if we were just to look at the two regimes separately, both agents are going to be worse off in the fiscally led regime, because there's this added uncertainty. Basically, these fiscal shocks now impact inflation. As long as we have some non-neutralities, that's going to increase macro volatility. And so you have this extra source of fluctuations that you don't have in the monetary-led regime. And in terms of price stability, there was a question that asked. So in this fiscally led regime, we're still, the inflation and debt, there's a unique and bounded path for inflation debt. So we're hitting by even when the government's spending, let's say even exogenously, if monetary policy accommodates, like with passive monetary policy, they'll still be able to hit the inflation target in that case. And then in terms of the open economy setting, so indeed, if we look at the US Treasury's large fractions held by foreign investors, so just one, without getting into like the trade balance issues, in terms of this redistribution, at some level, if we accounted for the foreign investors, that could potentially reinforce this effect, because in the case of the foreign investors, they're going to get fleeced from these unfunded fiscal expansions because of the nominal devaluation. And then on top of that, they don't get any of the transfers or any of the benefits from this. And so they're like asset holders that we have in this closed economy, but without even getting any transfers at all. And so that could also magnify some of these risk premium effects.
Okay, so thank you very much for a great session. Let me again thank our presenters and discussants. So final round of